Good afternoon, everyone. My name is Philip Bent, and today I'll be speaking about China's monetary policy in relation to countering the inflation risk that's been created since the economy of China has been transitioning away from a planned economy towards a market-based economy. Now, before we begin, there's a few things you need to understand. That's first, inflation. Inflation, very simply, is the rise in prices of goods and services within an economy. Secondly, we need to understand what a planned economy is. Essentially, China's a great example. They're a communist country, and what that means is that they have a planned, centralized unit within their economy that structures all of the development that goes on, such as real estate development or even job placement for certain people. Third, what we need to understand also is what a market-based economy is. And what that is an economy where the decision-making and economic development takes place in a very decentralized manner. So, for example, a local government could look to build a school or look to develop real estate in a certain area of land. So now that we understand those three things, let's talk a little bit about the Chinese economy and the two key inflationary risks that have developed. First, it's the inflation risk from the switch from a planned economy to a market-based economy. Essentially, with the new decision makers in power to invest the Chinese government's money or to take on new credit and invest in their local economies, a decentralized risk has been created where the aggregate demand or the amount of money that these decentralized decision makers are looking to place in their microeconomies has increased. So that's risk number one, right? An increase in aggregate demand that is not regulated by the Chinese government. Now, the second risk that's very important to understand is the risk of excessive liquidity in the market. Essentially, China, it's a very prosperous country. They act as a global supplier to the world, and because of this, they are at the whims of global demand. So if global demand increases, China's output also increases, and because they run a current account surplus, Chinese citizens are kind of world-renowned for their savings rate of roughly 25%. The Chinese government has a lot of money they need to invest. So historically, they've placed this money into their currency to keep the currency at a fixed rate. But occasionally, because of this current account surplus, there becomes an excess amount of liquidity in the market. And what that means, if there's too much money in the system, well, there's going to be a rise in prices of all goods, or inflation. So in 2003, China introduced the central bank bill to counteract these two key risks of inflation. The first part of the central bank bill that they introduced was to issue different central bank bills to the economy. Now, a central bank bill is really no different from a treasury bill from the United States government. Really what it does is soak up excess liquidity from the market by selling them a bond backed by the full faith and credit of the Chinese government that pays an interest rate. It's been very effective so far, and I believe this has been a very smart tool to introduce. More than only soak up liquidity, what it's also done for the Chinese economy is create a yield curve, right, from which different lenders, different banks and financial institutions can more accurately price their risk. Now, the second part about the bill, which is very important as well, is a loan-to-value ratio, which has been created to limit the amount of credit that can be loaned with certain assets as collateral. So it's very similar to what you'd see in the United States, right? If you're a consumer and you look to buy a house, you have to put a minimum down payment on that house, right? So there's a cap on the leverage or the credit that you're able to take on in order to buy a house. Well, very similarly, for investing in real estate development from these decentralized, right, decision makers, these local towns, governments, they now have a limit on the amount of credit they can take out per asset within their microeconomy. And I think the loan-to-value ratio that China put in place is a very good idea. I mean, it's very similar to a capital requirement or a reserve requirement for the financial institutions we're seeing now. Essentially, by limiting the amount of credit that these decision makers, these new decision makers, can take on, they've limited the inflationary pressure that's placed on the Chinese economy. However, an area of China's economic planning and strategy that I disagree with is China's pursuit for a fixed exchange rate. Now, whereas in the United States we pursue free capital mobility as well as freedom for sovereign monetary policy, China pursues the same sovereign monetary policy freedom. However, they've chosen to pursue a fixed exchange rate rather than free capital mobility, all wrapped up in what's called the economic trilemma. So by choosing to pursue this, the Chinese government has excluded foreign investors from taking part in their economic development. And what I would like to see happen, and what I expect to see happen, is that as China's economy grows and develops and becomes more important to the world, which we're seeing right now, in fact, earlier today I actually read in the Wall Street Journal that the Chinese renminbi, also known as the yuan, is going to be added to the IMF's special drawing rights. Now in my report, I actually include this as a potential thing happening in the future, right? It makes sense. The Chinese economy is very, very quickly turning into a global player. It has been historically, but as it continues to grow at what is this year going to be a 6.9% GDP growth, the economy will gain in such a standing and size that in one way or another, the Chinese government will no longer be able to support their currency and keep it a fixed rate. Because as the currency grows and expands with the economy, the amount of money that China would have to place to maintain the current level of their renminbi peg to this basket of currencies would be so excessive that it would just be almost impossible. So what I believe will happen in the future is that China will transition fully from this planned economy that they had in the 80s and the 90s to an actual market-based economy in which, just as we're seeing now, there might be centralized control, such as loan-to-value ratio or central bank bills that are released, but the market will be able to dictate the foreign currency rate, and just as the United States will have a much more free feel to it. So thank you very much for watching my report on China's monetary policy and how it acts as a kind of against the wind to inflation. It's been an absolute pleasure getting to speak with you all today and see you again. And in just a quick conclusion, I've covered how the economy of China has been transitioning away from a market-based economy away from a planned economy to a market-based economy. And from this, there have been developed kind of inflationary pressures to the economy, which the Chinese government has now countered by a central bank bill, which introduced two different aspects, two different laws. The first one being a loan-to-value ratio, right, on assets, and the second one being a central bank bill, which is used just as a treasury bill in the United States to soak up excessive liquidity that's been developed through the current account surplus that the country runs. So thank you very much, and I look forward to seeing you next time when I review The Wealth of Nations by Adam Smith in our final project of the book review.